Pause for a moment, not because of panic, not because of a rumor, but because something has already happened that most people won't understand until it's too late. This isn't a forecast. It isn't a theory. It isn't a what if. This was a real decision, executed quietly, at a specific time, by a country that sits at the very center of the global precious metals system. And once you understand what that decision actually did, it becomes impossible to see the silver market the same way again. At exactly 2 a.m. Swiss time, Switzerland didn't issue guidance. It didn't hint at reform. It didn't warn markets to prepare. It pulled the emergency brake. Large silver exports were frozen pending government review. Not slowed, not taxed, frozen. And that single action didn't just interrupt supply. It exposed how fragile the physical silver system really is. Most people hear export freeze and think paperwork, bureaucracy, delays. That's a mistake. In physical commodity markets, logistics are reality. If metal doesn't move, nothing else matters. Not futures prices, not analyst targets, not sentiment. And Switzerland isn't just another exporter. It is the refining heart of the global silver trade. For over a century, silver has flowed through Switzerland. Raw metal is mined all over the world, but refining is where silver becomes usable at scale. It's where impure output is transformed into standardized, trusted bars that industries, mints, and dealers rely on. The vast majority of high-grade silver used in investment products and industrial applications passes through a handful of Swiss refineries. That isn't influence, that's concentration. When Switzerland stops that flow, the impact isn't theoretical. It's immediate. And it doesn't hit charts first, it hits warehouses, contracts, and supply chains. What makes this moment different isn't price volatility. Silver prices fluctuate all the time. What makes this moment different is behavior. Institutional behavior, government behavior. And behavior is always the earliest signal of stress. Large systems don't break loudly. They strain quietly. Pressure builds in places most people never look, until suddenly the system behaves differently than expected. And right now, the silver market is behaving differently. The freeze didn't come out of nowhere. It came after multiple stress points converged. Physical inventories were already tight. Demand from industrial users has been accelerating. Investment demand has been persistent. And upstream supply had already taken a hit when other major exporters began restricting flows. In that environment, Switzerland faced a choice. Continue acting as the world's refining hub and risk running down domestic availability, or protect internal supply and absorb the global backlash. At 2 a.m., they chose protection. This is where many viewers underestimate the importance of timing. Emergency actions taken in the middle of the night aren't designed for optics. They're designed for speed. They happen when officials believe delay increases risk. And this wasn't a blanket ban announced to the world. It was implemented through customs controls, reviews, holds, quiet mechanisms that don't make headlines immediately, but stop metal just as effectively. That's why this matters now, before the story fully spreads. Because physical supply disruptions don't announce themselves with sirens. They appear first as delays, then shortages, then rationing. By the time everyone agrees there's a problem, the metal is already spoken for. At this point, it's worth asking a simple question. If the country that refines the majority of the world's silver decides to stop letting it leave, do you think that's because supply is abundant or because it isn't? Let me know what you think in the comments. And if you want clear, calm breakdowns of market moves before they turn into headlines, make sure you're subscribed. Now let's slow this down and look at the mechanics, because the real story isn't panic, it's math. Most silver doesn't sit in massive stockpiles waiting to be sold. Dealers, mints, and industrial buyers operate on just-in-time delivery. Inventory buffers are measured in weeks, not months. Regular shipments keep the system running smoothly. Interrupt those shipments, and the system doesn't adjust gradually. It tightens abruptly. When Swiss exports stop, the immediate effect isn't higher prices on a screen. It's shipments stuck in customs, contracts delayed, replenishment schedules broken, and once those delays cascade, downstream players are forced to react. Industrial buyers can't simply pause demand. Solar panels, medical equipment, electronics, and energy systems require silver continuously. When deliveries don't arrive, companies face two bad choices: halt production or pay whatever price is necessary to secure supply elsewhere. Dealers face a similar dilemma. They don't set prices arbitrarily. They price based on replacement cost. When replacement becomes uncertain, premiums rise. Not because of greed, but because availability itself becomes the scarce resource. This is why physical shortages often appear sudden to the public. The system functions normally right up until it doesn't, and then it changes fast. Another critical point most people miss is substitution. Silver isn't easily replaced in many of its applications. You can't simply swap it out without redesigning entire systems. That makes short-term supply disruptions far more severe. Switzerland understands this better than almost anyone, which is why the freeze wasn't framed as a market decision. It was framed as an economic security measure. Those words matter. They signal priority. When governments use security language, they are no longer optimizing for global markets. They are optimizing for domestic resilience. And once that shift happens, global availability becomes secondary. Right now, we are in the early phase of that adjustment. The phase where awareness lags reality. Metal still exists, products are still listed, prices still look reasonable to anyone not paying attention to logistics. But the underlying flow has changed, and markets don't reprice based on headlines. They reprice based on availability. Once the flow stops, everything downstream must adapt. And adaptation in physical markets is never smooth. Which brings us to the next layer of this story: how supply chain disruption turns into market behavior, and why the consequences extend far beyond silver itself. Once the flow of physical silver is interrupted at the refining level, the effects don't move outward evenly. They cascade. Some parts of the system feel the impact immediately, others with a delay, but none are insulated. And this is where the story stops being abstract and starts becoming operational. The first pressure point isn't investors, it's contracts. Industrial buyers don't operate on spot purchases. They operate on long-term agreements signed years in advance at prices that made sense in a different world. Fixed volumes, fixed delivery schedules, fixed pricing assumptions. Those contracts are the backbone of modern manufacturing, and they only work when supply chains behave predictably. But when supply tightens suddenly, predictability disappears. Swiss refineries now find themselves in an uncomfortable position. On one side, they have contractual obligations to industrial clients that expect delivery regardless of market conditions. On the other side, they see spot prices and premiums in open markets reflecting scarcity. Every ounce shipped under an old contract is an ounce that could be sold elsewhere for far more. That gap isn't theoretical, it's real money. This creates a conflict that cannot be solved by markets alone, because breaking contracts invites lawsuits, political pressure, and long-term reputational damage. But honoring them under conditions of scarcity can threaten the survival of the refining ecosystem itself. This is where governments step in. When industrial supply chains become vulnerable, markets stop being the sole decision makers. Political priorities enter the equation: jobs, strategic industries, national resilience. And once those priorities are invoked, export flows become negotiable. Switzerland didn't act because prices were rising. It acted because obligations were colliding. At the same time, upstream supply was already under stress. When major producing countries restrict exports, whether for economic, political, or strategic reasons, the refining hub feels the shock first. Inputs shrink, inventories thin, margins compress, and the margin for error disappears. By the time Switzerland pulled the brake, The system was already tight. The freeze didn't create scarcity, it acknowledged it. And that acknowledgement matters because it changes incentives across the entire chain. Once refineries stop shipping freely, downstream players begin adjusting behavior. Dealers stop offering long delivery windows, mince slow production schedules. Industrial buyers accelerate procurement where possible. Everyone tries to move first. This creates a second-order effect that most people underestimate. Competition for remaining supply intensifies even before visible shortages appear. Availability becomes a competitive advantage. In normal markets, price is the signal. In stressed physical markets, access is the signal. Those with established relationships, contracts, or priority status secure metal. Everyone else waits or pays whatever it takes. This dynamic also reshapes how risk is perceived. In paper markets, risk is modeled. It's hedged, it's quantified. In physical markets, risk is binary. You either receive material or you don't. And once participants realize that delivery is no longer guaranteed on predictable terms, behavior changes permanently. This is why physical supply shocks often outlast their initial causes. Even if exports resume later, trust doesn't reset instantly. Participants remember the disruption. They adjust procurement strategies. They diversify suppliers. They hold more inventory than before. Those adjustments reduce flexibility in the system long after the headline event passes. Another consequence emerges here: time compression. When supply chains are stable, decisions can be spread out. When they're stressed, timelines collapse. Actions that might have been taken gradually over months are forced into weeks. That compression amplifies mistakes and rewards early movers. This is why early awareness matters more than perfect timing. The market doesn't wait for consensus. It moves when enough participants act on probability rather than certainty, and institutions act on probability. This brings us to another critical layer of the story: strategic reserves. Modern economies don't leave critical inputs entirely to market forces. They maintain buffers, energy, food, medical supplies, and increasingly, industrial metals, not for profit, but for continuity. Silver sits at the intersection of multiple critical systems: energy transition technologies, electronics, defense applications, healthcare. Disruption here doesn't just raise prices, it threatens production, which is why reserve accumulation often happens quietly, long before public acknowledgement. When governments decide to protect domestic supply, they aren't speculating on price, they're planning for disruption. And planning for disruption changes how markets behave. Once a portion of supply is removed from circulation for strategic reasons, the remaining supply must serve the entire open market. That magnifies scarcity effects. It tightens availability faster than price alone would suggest. This is where feedback loops begin to form. As availability tightens, participants accelerate procurement. That acceleration drains remaining inventory. Reduced inventory reinforces urgency. Urgency drives further acceleration. This loop doesn't require panic. It only requires rational behavior under uncertainty. And rational behavior under uncertainty often looks like panic to outsiders. Another important angle is substitution risk. In theory, markets adjust by substituting inputs. In practice, silver's unique properties make substitution slow and costly. Redesigning components, retooling factories, requalifying materials, these processes take time. Time the market doesn't have during sudden disruptions. So instead of substituting, participants compete. This competition isn't visible on price charts immediately. It happens in phone calls, contract negotiations, allocation decisions. The visible effects appear later, when products quietly disappear and premiums widen. By the time those signals reach the broader public, positioning has already shifted. This is why physical commodity shocks feel sudden. The adjustment happens below the surface first. Another consequence worth noting is geographic fragmentation. When global hubs restrict exports, regional markets begin to diverge. Prices no longer move uniformly. Availability varies by location. Premiums reflect local conditions rather than global benchmarks. This fragmentation weakens the relevance of centralized pricing mechanisms. A quoted price becomes less meaningful if the asset cannot be sourced at that price. And once pricing loses credibility, confidence erodes. Confidence is the glue that holds leveraged systems together. Without it, participants demand certainty, delivery, control. Which brings us back to why this isn't just about silver. Silver is the case study. The underlying issue is how concentrated supply chains behave under stress. Highly efficient systems are often fragile. They work beautifully until they don't. And when they fail quickly. Switzerland's role as a refining hub created enormous efficiency. It also created a single point of pressure. When that pressure became uncomfortable, the response was not gradual. It was decisive. That decisiveness tells us something important about how risk is being perceived at higher levels. It's no longer being treated as hypothetical. And when risk stops being hypothetical, behavior changes first. Narratives follow later. Right now, we are still in the phase where behavior is shifting faster than stories, where logistics matter more than commentary, where awareness creates advantage. But that phase doesn't last. As supply constraints persist, the system is forced into a new equilibrium, one defined less by optimization and more by resilience. And that transition carries consequences that extend beyond any single market. Because once governments, industries, and institutions begin prioritizing security over efficiency, the rules of participation change. Which brings us to the final layer of this story: what happens when markets move from participant-driven flow to system-managed control, and why that shift reshapes outcomes in ways most people don't anticipate. When markets reach a certain level of stress, control quietly changes hands. In normal conditions, markets are participant-driven. Buyers and sellers negotiate risk, price, and timing. Liquidity comes from willingness. Volatility comes from disagreement. That's the phase most people think of as the market. But when stress persists and participation retreats, markets stop being participant-driven and start becoming system-managed. That transition is subtle but decisive. As private actors reduce exposure, responsibility shifts upward. Exchanges, clearinghouses, regulators, institutions whose primary goal is not profit, but continuity. At that point, the objective changes. The system is no longer trying to optimize outcomes. It's trying to prevent failure. And preventing failure often requires changing rules. This is the phase Switzerland is preparing for. Not because collapse is guaranteed, but because fragility has increased. And fragile systems don't wait for confirmation before adapting. Once exports freeze and strategic priorities take over, optionality disappears for everyone else. Participants don't choose how markets behave anymore. They react to constraints imposed from above. That's why this moment matters. In system-managed environments, price becomes a secondary signal. It reacts to forced behavior rather than genuine agreement. Spikes and drops reflect liquidity gaps, not conviction. Charts stop explaining what's happening. Instead, the real signals move elsewhere. Allocation decisions, priority lists, export approvals, delivery timelines. These are the levers that matter when structure changes. This is also when divergence accelerates. Paper markets can continue functioning because they must. Contracts trade, prices update, liquidity appears on screens, but credibility weakens. Physical markets, meanwhile, operate on a different logic entirely. Availability, access, trust. That divergence doesn't require default to matter. It only requires doubt. Once participants begin questioning whether promises can be converted into reality on demand, behavior shifts permanently, premiums widen, delivery windows stretch, willingness to part with physical assets declines. This isn't panic, it's rational adaptation, and institutions understand that distinction, which is why their actions are not statements about where silver should trade, but about when exposure becomes unacceptable. Silver can still rise sharply. It can also fall violently during forced liquidation. Both outcomes remain possible. What institutions are avoiding is being present during the moment structure itself is renegotiated, because renegotiation happens under pressure, and under pressure, systems prioritize stability over fairness. This is an uncomfortable truth about modern markets. They are resilient, but not neutral. When stressed, they protect the core first. Peripheral participants absorb the adjustment. That doesn't require conspiracy. It's how complex systems survive. Switzerland's decision fits that pattern exactly. Preserve domestic resilience. Secure strategic inputs. Accept global disruption as a secondary concern. Once that mindset takes hold, global availability becomes conditional. This also explains why transitions like this don't reverse cleanly. Even if export restrictions ease later, the damage to assumptions is already done. Dealers, mints, manufacturers remember disruptions. They diversify suppliers. They hold more inventory. They reduce reliance on single hubs. Those changes reduce efficiency permanently. The system becomes more resilient, but also more expensive, less liquid, and less forgiving. And that new equilibrium doesn't arrive quietly. It arrives through volatility, fragmentation, and adjustment. This is where many participants struggle psychologically. They want clarity, clean narratives, simple answers. But transitions don't offer those. They offer probabilities. The probability that liquidity remains thinner than before. The probability that physical and paper markets diverge further. The probability that access matters more than quoted price. The probability that delays and constraints become normalized. Institutions act when probabilities skew unfavorably, not when outcomes are guaranteed. That's the lesson most people learn too late. This moment isn't about fear. It's about alignment. Aligning expectations with structure. Aligning exposure with reality. Aligning decisions with uncertainty. Markets don't reward certainty. They reward preparation. Preparation often looks boring, cautious, even wrong until suddenly it isn't, which is why institutional behavior matters more than public narratives. Institutions don't always get direction right, but they are usually early when structure changes. And structure is what determines who has options and who doesn't. The export freeze wasn't loud, it wasn't dramatic. It didn't come with speeches or warnings. It came with a timestamp. 2 a.m. Swiss time. That's how transitions usually begin. Quietly, administratively, decisively. By the time the story is everywhere, the important moves have already been made. Understanding that difference between price and plumbing, between headlines and behavior, is what separates participants who react from those who adapt. If this breakdown helped you see why institutions and governments are acting, not just what they're doing, make sure you're subscribed. These structural shifts don't happen often, but when they do, understanding them early makes all the difference. And share your view in the comments. Do you think markets can smoothly absorb this transition? Or are we already past the point where volatility becomes unavoidable?